This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast. Hello and welcome back to another edition of the Three Wise Monkeys podcast, our weekly podcast that's all about the markets and investing. My name's Andrew Page, founder of strawman.com, and again I am joined by Matt Joss from mattjoss.com.
Thank you, Andrew. Very happy to be here.
And Claude Walker from ethicalequities.com.au.
Hi everyone, thanks for tuning in.
Hey guys, what are we going to be talking about this week?
Yeah, so this week, first off, I should announce that we're now on Spotify. So if you like to listen through Spotify,
What is Spotify?
We
for
have
your
made
music
it.
tuning, streaming needs, we're now on there. You can listen to the Three Wise Monkeys
This
podcast.
is a new web page I haven't heard of.
I'll fill you in later.
But yeah, so
It's on the
today we're going to be talking about a few results. So we've got Wisetech, BWX. And we're revisiting a company that I've talked about where we sold before, Kip McGrath, a company that Claude owns and has recently written up. I'm going to talk through the Australian recession. Dun, dun, dun.
Been waiting for a long time.
Andrew's going to talk through MSL Solutions and then Dicker Data. So we've got a lot of stuff to get
That's
through.
an eclectic mix.
Yeah, it's quite
so
a
it's
mix,
another
yeah.
earnings season bonanza.
Yeah.
With a spice of macro.
Yeah, of course.
Yeah, why don't you kick us off with some Wisetech?
Some
What happened there?
Wisetech. Yeah, happy to talk about Wisetech. So everyone, I'm sure, listening to this podcast is familiar with Wisetech, one of the so-called wax stocks. It's our sort of one of our tech darlings. Shares up 100% in the past year, 300% over the past 2 years. One of those ones that's perennially expensive, yet actually been driven by some really, really strong growth in their fundamentals. So as we touched on very briefly last week, they had some results out during earnings season and another really strong set of numbers.
How did the market react?
Well, I'll get to that because
Claude's jumping
that
in.
is really interesting. But first half sales were up 68%. They've now grown their sales at a compound annual rate of about 48% over the past 4 years. And that result that came in this season was better than expected, so above expectations. EBITDA, so operating profit with a whole bunch of stuff removed that companies and analysts love to talk about, that was up very strongly as well, 52%. That too has grown really, really strongly over the last 4 years or so, about 47% compound per year. And margins expanding over the past 3 years as well, in brackets, in small writing, excluding acquisitions. But this EBITDA figure, this operating profit figure, was below expectations and the margin was a little bit lower as well. Shares, to answer your question, Claudius, was down 14% after those results. So the market
Too bad then.
did not take it too well.
That's not too bad. 14%. I've weathered a few of those drops in my life.
You know what? I think anyone who has been with Wisetech for any length of time, even if especially if you've been with it right from the beginning, this is just another day. I mean, in the last 7 days, shares are up 13%. It's had 4 drawdowns over the past year alone, just eyeballing the chart, at about 20% or more. The biggest peak to trough decline that we saw over the last 12 months, 38%, when we had a bit of a sell-off towards the end of last year. So volatility, my name is Wisetech, right? Yeah. And again, I point you back to those figures I quoted at the start, which is 100%, 114% in fact so far this year, including the fact that it's pulled back from its all-time high. So this thing moves around a lot, as does Afterpay, as does Xero, as does Appen, as does all of those tech kind of stocks, because I think they're very, very sexy stocks, but for very good reason. But the market has a lot of trouble, and so do I, and I think so does most people, in getting their head around these valuations. So I'll throw some numbers at you here with Wisetech. These guys here on a price to sales multiple, so share price as a multiple of the number of the amount of sales that they've got over the past 12 months, 22 times.
22 times trailing sales.
22 times trailing sales. Let's assume their forward guidance is accurate. That brings it back to 18.5.
Yeah.
It's pretty high.
It's pretty lofty.
Really high. For those that like the more traditional price to earnings multiple over a trailing 12-month period, it's 130 for those playing along at home. Market average is 16, just to put that into context.
Yeah.
Now, again, I think we can be all clear here with each other that when you're looking at these kinds of growth stocks, you don't want to overthink this. As I said, this is a company whose profits are growing at about 50% per year and has been doing it for a while. They're chasing a $14 trillion market opportunity. They are the legitimate world leader. What's really, I think, exciting about this is that you have this once in a generation, probably once in a long, long time, where businesses, the logistics industry is switching from these legacy systems to the cloud. And you kind of do that once, right? And so this is a very, very big prize. These guys have a big advantage here. They are winning in this space, and there's a lot of money to make. So you don't want to go, I'm only going to buy this when the PE is at 16, because guess what? You never will.
Yeah. Or it'll only be if it goes terribly.
Yeah, and if it does get to that level, then something has gone horribly wrong. Claude, you wanted to ask a question.
So it was more just sort of taking a step back and maybe, I guess, understanding where the growth's come from.
Yeah, good question.
I'm not sure. I'm not totally across it myself. I don't own Wisetech shares.
I don't either.
Do you?
I should disclose.
Matt, how about you?
Yeah, I own. Yeah.
Yeah, so maybe...
Of course he does.
So maybe
Of course he does.
Well, but I'm kind of keen to hear from one or both of you a little bit of an account of the acquisitions that have built the business, or at least the important ones.
So this is a really good question. They've done a ton of acquisitions, a ridiculous amount of acquisitions. In fact, they've done, I think they've done something like 12 this financial year alone.
Yeah, that sounds about right.
Right,
Yeah.
and we're not even through that. We've just sort of passed the halfway mark here.
Yeah, but yeah, I guess many of these are very tiny acquisitions. So they have a strategy of kind of growing their global footprint. Wow, getting tongue-tied. By making these acquisitions, so they're kind of like acquiring a bit of local knowledge, a lot of customers. But then a lot of the companies they're acquiring aren't even really technology companies. It's more like the local kind of customs agency, etc. And it kind of allows them to get their foot in the door in a whole range of different geographies, which allows them to kind of have a global footprint. There are some larger acquisitions mixed in along the way, and one of the most recent one was a fair bit larger.
I think one of their biggest to date.
Yeah,
right? If not the biggest.
Yeah, I think maybe one other would challenge it. I have to double check the numbers, but
yep.
very, very big. And so, yeah, it's kind of a slightly different approach, but the main approach is adding acquisitions like you'd add a new office. And instead of having to go and set up a new office greenfield, you're kind of buying one and then using those customer relationships and kind of leveraging the network. So it's an interesting strategy. I think that they've been executing it fairly well. It does get a lot of questions from people about, are they just buying all this growth? The fundamentals, there's a few different ways they break it out. One of their favorite charts that all investors love looking at Wisetech is their cohort growth over time. So, the customers that they signed up 10, 15 years ago are still growing in revenue today. Like every year they're growing, over 100% retention rate, all that good stuff. So I think that it makes sense. I don't think it's just a pure roll up. I think you'd be wrong to think that. However, the valuation is extremely rich by classical measures. So I think you need to bake in that growth for a while.
Absolutely. One of the troubles with a lot of acquisitions is it tends to add a huge amount of goodwill to balance sheets as well. So if things don't work out, and statistically they don't tend to more often than not. So it does lead to potential for write-downs in the future. One thing I will say about their acquisitions though, which is rarer than what you would like, is that they have done this with virtually no debt. So this business is essentially debt-free on a net basis, and even on a gross basis, it's very, very, very modest. And their share count has been very steady. So there's one thing to make a ton of acquisitions and just issue shares like they're going out of fashion and take on a ton of debt. These guys have done it with a very, very clean balance sheet and by keeping the share count, which is a very, very, very good sign as well. So I guess just to wrap this up, because we've got a lot to cover here, it always comes back to, so is it too expensive? For me, I think it is. And again, I think you can get caught up in a lot of these multiples. So jump onto strawman.com. I've got a valuation there for anyone who sees a breakup in it. But I think if you just roll some numbers forward, you say, hey, look, I reckon they can grow their top line at 30% for the next 5 years. Certainly they've got that runway. Certainly that's less than what they've done in the past. Takes them to about 1.3 billion in revenue. You apply a net margin of 20%, not unheard of, quite reasonable, in fact, for businesses like that. Discount that back by, apply a PE of about 30, 35, CSL, Cochlear kind of multiples for much more mature businesses, not hard to do. I discount that back by about 10% each year and I get around 1870 or or so, give or take. So you can overthink this stuff, but there's a lot going right with my scenario there, and I still struggle to get to $19. So while, again, I don't want to overthink it, to me it's a little bit on the expensive side. If it was to get below $18, again, though, I would join you, Matt, in being a shareholder, I think.
Yeah, and I guess just to add my 2 cents, it is more stretched than some of the other companies I own, as we talked about some of them last week. So I guess closer to selling than backing up the truck, but willing to give a fair bit of rope to such a great business.
Let's move on. Let's talk about BWX, from logistics software to skincare products.
Yeah, so I'd spoken in BWX late last year, I guess, talking through why I'd sold it. So I thought it was a good opportunity to revisit it because the shares are up almost 40% on earnings. So they had fallen a fair bit before then. But anyway, so the results came out. Revenue was up just over 1%, 1.4%, so not too great. Net profit was down 51%.
A relief rally.
How did that rank relative to what they were saying, though?
The reaction was positive because I think that the kind of outlook wasn't too much more negative than what they'd previously said. Like, it was actually still a downgrade on the outlook, but it was close to the previous one, and the market had expected so little. Yeah, so I mean, going back to, as I said, I sold this at the time of the takeover for $6. It's now it got down to $1.60 and is now $2.40, so it's still a fair way to go from there. But yeah, so all the core numbers that you'd want to look at are down. It wasn't great. Sukin had been the core brand of the business. The revenue was down 36%. That was a business that had been growing at 24, 30 odd % for a while.
What was management's explanation for that?
There was like a slide, which was basically excuses. Like for some of them quite reasonable. So the management buyout that failed, took a huge amount of attention for a long time. They also upgraded their enterprise resource planning system, their ERP system, which they had flagged before. And I remember when I was a shareholder, when that came out, it's like, normally that's a red flag. And I was kind of asking them about how it was going. Of course, it's always going great.
But those things never go well.
It's like the standard thing. If you move that, you're going to miss. But yeah, so that brand being down is a pretty big cause for concern for me if I was going to be buying today. And I think we talked a little before the podcast around like what multiple would you pay for this. So on a EBITDA basis, based on their guidance, it's still at 12 times EBITDA, enterprise value EBITDA. So that's a pretty decent multiple for a business that's been declining.
To me, that's a multiple that implies growth.
Yeah, it does.
Right?
Yeah, absolutely.
Not eye-watering growth, not Wisetech growth, but growth, right?
Yeah. If they deliver on that second half that they said they're going to do, and then they can keep doing that like run rating, then it's only about 8 times. So it's not crazy now. I don't think it's like crazy expensive by any means. And if they can turn the business around and get Sukin growing again, then it would be fine.
Don't think it's crazy expensive?
I don't think it's crazy expensive to be at 8 times if they deliver on their guidance.
But at 12 times EBITDA, basically, to my mind, is not just pricing it for growth, but also for growth and a good business model. Is it sort of comparable to other fast-moving consumer good companies that might have stronger brands?
Yeah. So I guess I'd say it's if they deliver their guidance, which would put it at about 8 times on a run rate basis. I mean, I'm still not a buyer at these prices. It's just not that I'm saying that it's a fire sale, I guess, or shut it down.
Yeah, I'm the same too. You know what? It reminds me of other businesses that have had stellar growth and then a big stumble, and then have seemingly managed to sort of get their footing and resume that upward trend again. They for those kinds of businesses, an 8 times multiple on that operating profit EBITDA actually isn't too bad. Vocus was actually at about that level when it was at its depths.
Yeah.
And they sort of seem to sort of regaining their footing as well. So it's not that you can't do well from these, but it does take an iron constitution, I think, to do that.
Yeah, absolutely. And I mean, it could be a good business if they get the brand sorted. Like it can be a fairly good thing to own such a great brand if it's doing well. But with Sukin down 36%, and the only growth really coming from the acquisitions that get again a full 6-month basis. Not too attractive to me.
So it was a pass when we first spoke about it, Matt, and it's a pass now.
Pretty much.
I mean,
I'm with you.
I think it's worse than a pass. Have I gone crazy, or was it once upon a time, overseas Daigou, they're buying Sukin out of our supermarket shelves and out of our Priceline and chemists, and they can't get enough of our natural healthcare beauty products, and it's just driving all this demand. And then this has just evaporated, and sales of this.
And that is very much a warning lesson to this kind of space. I mean, the fickleness of consumers is legendary, and what is the hottest product this year may not be next year. So you just got to roll that into any optimistic
but
assumptions.
also,
you may
I
have.
feel like listening to this whole story about A2 milk, which I caved and bought. Is the whole thing was it's good to have, the premium brand, and that will continue to get the Daigou buying and stuff off the shelves. Having you can get it in Woolworths for 20 cents more than the Woolworths brand one. I don't think it has the same.
Yeah, there's not so much cachet.
Yeah, exactly. Yeah. And there's so many competitors in that space as well.
Yeah.
Big competitors.
Which I think have more cachet. So I imagine that people are still buying those products. Why are sales of Sukin down? Is it that people are buying less of that product?
Yeah, and I'd say the key thing to separate there is, there's a lot of reasons profits would be down with all this management, like just the buyout cost them, they calculated $4.5 million. They wasted, the company wasted on a potential management buyout. But it's not like consumers are looking at that Sukin on the shelf and going, I'm not going to buy Sukin because there's a management buyout.
No,
no one would have a clue.
Yeah.
Right? So I think that to your point, it's more, that suggests there's more of a core problem with the brand.
Yeah, so
they're saying will be addressed, so they'd have to deliver that before you consider looking at it. But a very big question mark.
Okay, cool. Well, that's the thing to watch then, not just the profit.
All right. Let's move along. Another company we've spoken of previously, we're nothing if not consistent, is Kip McGrath. Tell us about Kip McGrath, Claude.
Yeah, right. So I mentioned this one not long ago, actually, just before the results. It is, quick recap, it is the very small Australian company that's a franchise for Australian school students and UK and New Zealand to get a bit of supplementary help with their basics. We're talking maths and English mostly here. And yeah, we just thought we'd do a quick update because they reported some decent results. And
shares have been on a bit of a tear since then.
Also, last week I did MNF group, which wasn't so good, but it's nice to have a few winners as well from time to time. So yeah, look, Kip McGrath's been a long-term holding for me, and it's just good to see the thesis continue to play out. What we saw in the most recent half was, I think, it was a good half. It was lucky. Some things went their way. We still negatives first. We still see relatively slow progress on their they call it on-screen tutoring offering. But I'm glad they're investing in that because I think ultimately things will go that way, and they are seeing growth there.
Do they give any sense of how big of a share on-screen is versus the rest? Is there any...
you could probably investigate and get a better idea than I have, but it's for so long it's just been very small so I've not been thinking about it, and I'd say it's still there. What they did say, they're not great at reporting on this particular metric, but what they did say that it was up 50%, which I think assuming the hours.
Yeah.
But this is off a low base of, I think, 1,500 hours, which across a whole network when you've got 500 tutor franchises all teaching multiple hours of lessons every day, this is quite low.
Yeah.
So that's a bit of a negative. It's going slowly, but I'm glad they're investing in it, and I think they'll get there eventually. Look, other than that, it's basically a story of gross profits going up because their network is doing more lessons, and as a result, and they're keeping costs in check. So as a result of that, net profits going up. We're seeing a slight lag with free cash flow, in partly just because of movements of payables and receivables, but also partly because you do have a slightly increased investment in the technology, which is, again, totally the right thing to do. You need to make sure you're adding the value to those franchisees so that everybody's happy. And so what they've had to do is they're retiring software, replacing it, making it better. Makes sense to do that. They're going to keep doing that going forward. Yeah, balance sheet's healthy. Look, profit. The headline result: profit up 40%, which is great.
Fantastic.
Now what they've also said is that, as with most years, they expect the profit in the second half to be stronger than the first. So if you just basically say it's going to be the same plus 2%, then that puts it on a forward PE ratio of 20. Now, again, looking at the balance sheet, you have a slight bit of leverage going on there, but it's very small. It's like a couple of million is how much, the liabilities exceed the net cash. So it's pretty safe balance sheet. PE ratios are pretty reasonable way to assess this one. And, for this sort of level of profit growth versus the PE ratio, if they can even just maintain it at anywhere near these levels for a couple more years, it'll pay for itself. It's increasing the dividends. For me, it's one of those few stocks in my portfolio where you can very quickly sort of draw a line of just keep doing what you're doing and you bring me my money back without the share price moving.
Not dependent on the market.
Yeah, I mean, it is a little bit, but at the same time, it looks
far less than
it looks undervalued to me.
So even after because I think since we last spoke about it, the shares are up like 18% or something.
We should wind back a bit there. Like, I've been writing about this since it was 30 cents. Mm-hmm. And I've been buying it as low as 19 cents. And I most recently bought it 85 cents right after the results came out because I saw that they were pretty good.
Yep.
And so I obviously own shares. Do you guys own shares?
I bought it 85 cents as well. Very happy.
Nice.
I
was
Andrew.
Here when you were talking about it. And I should come back and look at that.
No, thank you, Claude. Got your tip there.
So I think it was good value at 85 cents, but it's up a little bit now to $1. But at the same time, it's still pretty reasonable value if they can deliver. So I'm pretty happy to hold on and wait for the fundamental growth to come through. If it doesn't, of course, the whole thesis is off track because I'm considering that I'm not saying that growth will be at 40%, but definitely double-digit growth in net profit for a couple of years from now is what I'm looking for at a bare minimum. But, of course, you do have some upside if they can keep the growth high.
And just to be clear here, you're really talking over a multi-year time frame here. You're not no idea what's going to happen next month or whatever.
Yeah, I guess for this one, my thesis would require growth over the next couple of years.
Yeah.
So, yes, it's a multi-year. I've already held this for a very long time, and this is a long-term holding for me, but I can keep measuring that thesis every single report because I want to see double-digit growth in each report. So, yeah, that it was a great report from Kip McGrath. It's a relief for me because they're my second biggest holding. So, yeah, just good on them. And
happy days.
Nice.
Just a reminder of the bearish side of things. The founder is selling shares. He said he's selling some shares. So there is that ongoing liquidity that's going to keep happening for the next little while.
Mm-hmm. Okay.
Nice.
Well done, dude.
Yeah, excellent. And maybe another reminder of the bearish side of things could be talking about the Australian recession. So it's Tuesday evening, so the GDP numbers will be out tomorrow by the time you're listening to this. So
get your popcorn ready.
But it's interesting. So the last quarterly GDP slowed dramatically. It was down to 0.3% up for that quarter, which is quite low. And this number for this results, I have been quite bearish on. There's been a lot of negative news coming out for a while. And I think, unfortunately, the rest of the economists seem to agree with me now. The night before, I was hoping to have a big contrarian call that might be close to accurate. But it looks like GDP is going to be quite soft tomorrow. By one definition, we'd be in a per capita recession, which means the economy is growing slower than how fast our population is growing, which I'll come back to in a second.
Yep, there's a bit to unpack there.
Yeah, but the interesting thing for me is kind of thinking through, the market has been extremely bullish. Like we've been seeing the whole market, all of the growth stocks up, some of them up like 12% on no news, even more.
Yeehaw!
Yeah, and so if you look at the underlying economy, we've all known that house prices are slowing for a while, which drives the biggest part of the economy, which is consumption. So for a while, I've been kind of thinking what part of the economy is actually growing. And the answer you typically hear is government spending and the infrastructure boom. Mm-hmm. But construction numbers have already come out, and they were quite negative 3% for the quarter.
Yeah.
The government wasn't very positive at all, plus 0.3. Trade was another detractor, which just leaves consumption, which we'll find out about tomorrow. And it's getting to a point, I think, where we're not just close to like a GDP per capita recession, but potentially a recession, which Australia hasn't had in almost 30 years, early 90s.
Yeah.
And so that number, I think, is one to watch for those that invest in the share market, because I think the sentiment will start to change pretty quickly if we have an actual negative GDP number. And then, obviously, we just need one more, and then you've actually got a recession.
Okay, so why do you think the sentiment will change if there's... I don't, maybe it seems a stupid question, but why will the sentiment change on this, especially if people such as yourself and other people that are smarter than me may have already sort of seen this possibility coming?
Yeah, so I think the big story change that could happen is that Australia will kind of decouple. So for the last 6 months, there was kind of that big sell-off in December. That was really driven by the US and kind of panic there about tightening. But if Australia is having its own kind of economic story, which hasn't happened for a while, the whole world's been pulled in with this quantitative cycle. I think that would start to change the sentiment quite a bit, where people suddenly aren't so bullish. and that also affects everything else that we see. So if households aren't spending, if property prices are down, there's kind of this negative effect on consumption, which is 60% of GDP. I don't think that people will be as willing to pay 30 times sales, that we've seen generally.
So we've got a few factors pointing to this here, but surely mining will save us.
Mining didn't actually really contribute. So trade was down 0.2% for the quarter. That was the last one that came out. Mining.
But haven't you seen the Rio Tinto ads and BHP ads?
What's going on with
Why
these
are
ads?
they doing that
They're
for?
the core of this country.
Is that a
man.
political thing?
They may only employ some tiny number of people, but surely they'll save us.
Yeah.
I detect some cynicism there.
Is it my face?
Yeah, so that's one that I'm watching, and for me it's about it's an interesting one for me because I've been positioned outside of direct Australian exposure for a while. Most of my companies are international growth companies, or most of their operations are overseas. Yeah. But the multiples could get crunched pretty hard. So I guess it's something that I'm mindful
to
of.
Psychologically steel yourself for, even if it's just the possibility, because it's far from a guarantee, but it's inevitable, as sure as night follows day, that this kind of thing will happen at some point. Let me throw something else into the mix there as well. Am I right in saying that new car sales were out recently over the last week as well? A really good indicator of a forward indicator of the economy, because it's such a discretionary spend, and that's just been collapsing, right?
Yeah.
And then add to that, we've got China, the second biggest economy in the world, downgraded their GDP guidance.
Yeah,
now
that's right.
it's only quote unquote 6 to 6.5%.
Yeah.
Which is ridiculous compared to any sort of developed country. But for them, it's actually quite the slowdown.
What was their previous made-up number?
6.5 plus, but yeah.
Exactly, which they hit perfectly every time.
Going to make up a lower number now.
Yeah, but I guess that's part of the interesting point. I wouldn't predict a really harsh recession right now, but everything's just softening, which is kind of like if there is a blow from Chinese, collapse or slowdown or something like that, Australia would not be in a good position to weather it compared to where they were a while ago.
Before we move on, I guess this has come up before. We're going to get branded as like the perma bears here, which fair enough.
No, it's not fair enough given we're all massively long growth stocks.
I think that's why I want to layer in some context here, because I think it's very easy, particularly for first-time listeners, to go, oh my gosh, Matt's saying it's going to be a recession and multiples are going to contract and it's all very scary. How do you practically, Matthew, how are you positioning, playing, thinking about this kind of thing? On one hand, you're quite bearish, evidently, but on the other hand, what are you physically doing in the real world?
For me, it's just a matter of getting tighter on all the valuations that support my thing. So being less willing to just kind of hand wave away, it's a great business, and saying, am I comfortable paying X price for this asset, knowing that I might have to hold it for another 5 years?
So just on that, because we've talked about it this very episode, Wisetech, you've got shares in that. You've just agreed with me before that maybe a little bit expensive. Is that something you might consider trimming down a little bit in this kind of...
Yeah.
Sorry to put you on the spot, but is that a good example?
That's a good example of something that I'd be looking to potentially trim.
Okay.
Example.
Nice one.
Yeah.
But would you... How many of these questions can we ask?
I'm cutting you off. I thought I'd reach out to the audience. I thought it could be interesting if any what's going on in the real economy. So it's really weird, right? It's March and we're only just finding out what happened in the economy in December.
Yeah.
So yeah, if anyone wants to write in 3wisemonkeys@gmail or tweet at us,
Please.
What's going on in your sector of the economy, I'd be interested to hear, like on the ground stuff, which it takes so many months to filter through.
Yep.
Maybe things will rebound. Maybe the government will pick up. But yeah, interesting.
I think I find that a very hard. We all live in various bubbles.
Exactly, right?
Do you know what I mean? And
I talk to you guys. We're all bearish of property and whatever else.
Right. So we just give massive confirmation to each other. There's got to be other people out there going, actually, things are really great for our business and the industry I work in. Never been brighter. So it's always great to sort of test that thinking. So yeah, if you can, send us an email.
I'll leave it with one positive for GDP, which is Australia's population growth, which is just insane. So it's 1.6% a year. So if we just keep up with that, like that is GDP growth. That's huge.
Yep.
To put that in context, the US is only 0.7. India, which you think
0.7 population
growth.
Okay. Well, they've got a wall almost.
And India is only 1.1%. You think that's kind of like a booming population, but Australia, that is why we've had 30 years of unbroken growth. If that continues, and we just do it, it's we can muddle through.
But there'll be enough stadiums for everyone. New South Wales has us covered, guys.
Speaking of
Jobs and
sports and
I love it.
how's
I
that
love
transition?
it. Very good. I'm going to do this one really quickly. Excellent segue, by the way. So what Matt's getting at here is MSL Solutions. These guys have a bit of software that cater to the sports, leisure, hospitality, and stadia sector. It's been on my radar for a while because it's one of these SaaS businesses that just ticks all of the kind of boxes. You know, the usual high rates of retention, capital light, recurring revenue, yada, 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 all of that kind of stuff. Only trouble is shares have gone from 20-something cents all the way back to about 8 cents in the last year. And it's been an absolute disaster. It's something that I actually tipped on Strawman a little while ago and has not been my friend. So the question is, what's going on there? We have talked about it previously on the podcast, so I'll point you back to that if you want a bit more detail. But they had their results out recently, and we saw a 3.5% drop in revenue. So this is a business that, again, supposedly only 5% of the addressable market, was, in fact, has been growing really, really strongly since it's been listing and even prior to listing. And then, so to go from strong growth to negative growth, if that phrase even makes sense, is a real holy moly, what's going on here? Not just that the operating profit loss widened, and so the market just went, understandably, what the hell is going on? So the question here is this thesis busted, or is this an opportunity? The hard part, we always talk about this, is sort of dusting yourself off, coming at it fresh. I tried really hard to do that. And there's two narratives here, so I'm gonna outline both for listeners. The bears will say very plausibly that, look, they had all this big opportunity, but we're just not seeing it come through at the top line. At the same time, they have ramped up their R&D spend by 35%. Sales and marketing costs have increased by 42%. Their cash burn has gone from something that was already significant to even more significant. They've only got a tiny sliver of cash left in the bank, and based on the past 6 months of cash burn, they're going to run out of money, like almost certainly in the current half. So. How does that float your boat, Claude? You got you interested?
Yes.
On the other side of the equation, the bulls are saying, well, you have to factor in there is a great degree of seasonality in this. The second half is always stronger. Management are actually talking about a much stronger second half, so they're in that infamous second half club. But what you also have to understand, and we talked about this, I think it was you and me, Claude, when we last talked about this business, was that these guys are transitioning to a subscription model. So previously they sold upfront, and that means you got all your money at the beginning, and then you sort of had less maintenance revenue over time. This SaaS model, these subscription models are so much better. You get far more visibility of your revenues. You end up getting more money over the long term. Implementations are easier. Maintenance is easier. All of this stuff it's just a far, far superior model. But when you do transition, there is a bit of pain. So the business is talking about that. In their most recent results, they were at pains to point out that yes, we know that our revenue is down. Partly there's a little bit of slippage into the second half with some work. But if you look at the recurring revenue component of our business, there was a 15.5% gain from the previous corresponding period, even from the preceding period, which is historically the second half always our strongest. There was a 4% improvement. And the company reiterated their guidance that for the full year, they're expecting the recurring revenue component to be up about 16%, give or take, year on year.
Yeah, they should definitely get in touch with you for investor relations. So I can't believe.
Do I
Did
do
you just do
a good
that
job?
for free?
No, well, I think, hey.
Of course he did it for free.
I think, excuse me, sir. I think I was very candid on the bearish side
you
of
were.
things
Of course,
as well.
I'm joking.
And so I'm joining. That was the Bulls. That was the Bears before. This is now what the Bulls are saying.
But
they say that they will be operating cash flow positive in the second half. Now, this is my takeaway.
will they be for the entire year?
No, they won't.
Sweet.
But it means that they avoid a capital raise. If there is a capital raise with shares at 10 cents, not even, that's going to be massively dilutive. Really, really, really painful. So here's the thing. If you believe what management is saying, if this investment in sales and marketing and R&D, and we just talked before how essential that is for growing business, if that pays off, if they manage to avoid a capital raising, and they make this transition to subscription, this thing is crazy cheap. I mean, these guys are trading at like 3 times recurring revenue.
It's hard.
I'll get to it. On a forward PE basis, excluding amortization,
PE?
this is on a PE of 8.
What?
Right?
Where is their E?
Have a look at you've got the presentation open. Check it out.
I've got the financial results open, and I see massive losses.
Yeah, so it's NPATA. Anyway.
Wait. What is it? Where does this like magical E come
Check out
from?
the most recent
E, by the way,
half-yearly-
is supposed to be earnings, except when we're talking about this company, and it is some other.
No,
magical
you're right
metric.
to be skeptical. And by the way, I'm not saying
So
this is
let's talk about facts.
Okay.
Fact. The loss for the period, according to their most recent report, was 3.1 million. Fact. Revenue was down. Need I go on?
Yeah, no, that's exactly what I said. So it was a shocking half. Revenue was down, EBIT loss widened. Exactly what I said at the start.
No, I know you covered it. The bear case like really outlined the situation quite well.
So this is what is interesting about it. Now here's the reality about investing in the share market. A rosy consensus gives you no opportunity, because when the market is very favorably disposed towards a business, you pay up for that. And generally speaking, efficient markets will almost guarantee you that you're not going to get an adequate return, even if the business does incredibly well. So the thing here to watch is to say, which side do I fall on here? Yeah. If the bears have gotten too much sway recently, as I said, this is 1.2, 1.3 times recurring revenue. Even if you go this a 2 times annual recurring revenue multiple, this thing's worth 14 cents. It's a 40% upside from here, right? Minimum, if those things go well. If it doesn't, of course, and they raise, this thing could be 3 cents. So there is an asymmetry here. It is one where I kind of lean a little bit on the side of bullishness, but it is a very, very difficult call. I pointed out because it's interesting.
You lean on bullishness.
I think,
but none of us own shares.
I think when you weigh it up, I think that there is a contrarian within me that actually thinks things deserve. Share price was, in hindsight, was never deserved to be 20 cents. In hindsight, I think 8 cents was crazy. And I think that there's potential here for a good upside. I would only have a very small position. It is extremely speculative. Give us a very, very quick summary of Dicker Data.
Well, look, I mean, we can cut it short if you like, because there is a fantastic write-up by Matt Brazier on Dicker Data on ethical equities.
Nice.
And I actually did the write-up on Kip McGrath for those that are interested in that one. But yeah, so we've covered Dicker Data on ethical equities multiple times. It was our preferred stock for November 2018. Share price was $2.81 then. I mean, I've said the thesis before on multiple mediums, but to outline it for podcast listeners, it is basically that this is a well-run company. Founders are paid rather modestly. They own rather a lot of the company. They remunerate employees in a way that respects all shareholders, and they pay out 100%, more or less, of profits as a dividend. So it's definitely a dividend stock. Mm-hmm. Basically, what has happened recently is first they had their sort of guidance out there, and then they did an upgrade to guidance, and then their results came in, and they were pleasing, and the market sort of pushed it up on all of that. The key to it is that on their last dividend of the year, if they've got extra earnings, they'll pay out an extra big dividend. So they paid a 7-cent dividend along sort of to reflect their final results. And that sort of gives you a hint that their results were good. So that was all really positive. And essentially, then they've gone and given guidance for 2019, which basically says they're going to do 22 cents in dividends, which even at the current price gives you a pretty attractive fully franked yield of 6.1%.
6.1% after that massive run-up.
Yeah. So it was really good before.
Okay.
And yeah, no, I still think it's decent. I haven't sold any shares at this time. I would consider selling some at some point, potentially, just to rebalance. It's becoming a fairly big position. Now, the downsides of this company, for those that aren't familiar with it, is it uses a lot of debt. It's in the business of IT distribution, so it has large capital requirements.
Yep. Low margins.
Yeah, low margins, so it needs to borrow money to finance its inventory, which it then sells at fairly low margins. And basically, its bread and butter is being an efficient operation so that it can make a profit in doing this distribution service. And look, it's essentially just a well-run company in a pretty unsexy business. I say read about it online. If you're interested, it's a good dividend stock. I like it. But at the same time, it's run up a lot now, so I'd be pretty cautious at current prices.
Well, there you have it. I think that's it. That's a bit of a wrap.
Yeah, thanks everyone for listening. It's been great.
Thanks, guys. Definitely feel free to get in touch with us. Ask us your questions. It's always great to have inspiration of what we should cover next, especially as we're moving out of earnings season now.
Yes, definitely. And look, it's always great to have your company, but we will be back next week with another episode of the Three Wise Monkeys podcast. Until then, thanks for listening.
Thank you.